reason you choose to, these are going to be up on my YouTube channel, just like the rest of my lectures are. And you can go on there and get any of them as well. So now let me go through the process of this again real quickly and say, well, good morning to Nikki and Patty. I saw y'all just came in, so good morning. Applications, guys, are you getting your applications in order?
Yes.
Okay.
Yep.
Has anybody yet reached out to PSI to find out what the dates are for that they're booking? Has anybody done that yet? Okay.
I have not.
I know it was the 19th, but that was 2 weeks ago, so I suspect that it's probably end of month at this point. Jackie, I know you were not in a hurry to get yours done, but at some point that'll change, and you'll be.
I just am not willing to put my health on the line for the test right now. That's really it.
Yeah. Oh, okay. So you're still standing down because of that. And as long as you have a study strategy, that's okay. They will take precautions at the testing center, but I have no control over their precautions. So when your application is in, and by the way, Jackie, your application is good for 6 months. So if you want to go ahead and get that in progress, your background.
Yeah, I mean, I ordered the background check. I'm just watching the news every day and seeing the rates go up. So I'm not going to go yet until I see the case, reporting go down.
Okay. Yeah, you got 6 months there. And like I say, devise your own strategy for what pace to study and stuff like that. My reviews will probably stop in about a week or two because I still will finish this one up today, and then I owe you a math review. And then after that, obviously you have access to me, but it will not be on a formal basis. It'll be more like a, like office hours or something like that, like the teachers have office hours. So that's the way we'll deal with it from here on out. So anyway, do you have any questions about where we are right now? Good. Nothing's changed a whole lot. Just stay in whatever speed you want to get it done. All right. I have my notes up on the screen. You can have yours nearby if you want to. It's not necessary, but we will start walking through this. We're going to have some simple stuff, and then we're going to have some tough stuff. Okay. So if everybody's ready to move forward, I'm going to jump into the notes. This chapter was just a small chapter. We didn't spend a whole lot of time in here. To be honest with you, I probably have. I'm sorry. I'm going to mute everybody real quick just to get rid of background noise. Okay, you're all muted now. So if you want to get in, make sure you hit your space bar to get in. So this was a little chapter right here, federal tax implications of home ownership. This is one of those chapters that, you almost forget that it's even there. However, it's good for maybe one or two questions. Notice what the name of the chapter is, federal tax implications of home ownership. So we're really only talking about two things in this chapter. One, we are talking about what you can write off of your taxable income. For those of you who own homes, this probably should be just a review for you. By virtue of the fact that you own a home, you can write off of your income taxes, your real property taxes. You can write off your mortgage interest if you have a loan, the interest that accrues on that, you can write that off. And discount points, which technically discount points are nothing but prepaid mortgage interest. So what happens is you write those off during the year you paid them. Let me put my window down so that y'all don't hear our trucks going by. So anyway, that's just memorization. If I had to tell you any tricks on that, I can't imagine they're going to go this route. Mortgage interest is deductible up to $1 million of debt. So if you had a loan of $1 million, well, actually, if you had a loan of $2 million, only the interest that accrues on the first million would be tax deductible. I don't have that problem because I don't have $1 million loan. You could technically do this on two houses simultaneously, but it would have to be two homes. For example, the people that live up north in the summer and move down south for the winter, and they literally have two homes. Talk to your accountant about that if you want more information, but that is a truism. And then discount points, you write those off during the year that you pay them. If for some reason you refinance and pay discount points, which I don't know why you would, but if you did do that, you'd have to, if you refinance, you have to take the discount points over the course of the loan. Now keep in mind, the first thing I said was what's important. This is what you can write off your taxable income. The last little bit I talked to you about, it'd be a long shot that they would ask that question. So don't get bogged down in this chapter. There's only 1-2 questions on it. Then the other thing that's important about home ownership and taxes is the change in capital gains treatment since 1997. And this is again on your home, But on your home, you do not owe capital gain taxes if you've lived in the home for at least 2 out of the last 5 years. It doesn't really matter which 2 it is, just 2 out of the last 5 years. And you didn't make more than $250,000 in gain. Okay, now again, let me remind you what I said. It doesn't matter what you sell the house for. The only question is, how much did you make in regards to your gain? I don't know. Yes, I do have it down here. The calculation for capital gains. Notice I don't have a math question on this because you are not tested on the math for capital gains. Actually, you're probably going to wish that you were because it's an easy math question, but I do need you to remember just some bullet points about capital gains treatment of home ownership. If you're single and you don't make more than $250 in capital gains, you owe the government nothing on that. If you're married, it's even better. You could make up to $500,000 in gain and not owe any capital gains taxes on that. I don't know if you remember in class, I told you just a quick story on this, is that when I was younger, I would buy houses every 2 years. And the reason I'd buy houses every 2 years is I would just simply buy the house at a discount, live in it 2 years, sell it for a profit, and I can do whatever I want to with that money tax-free because it was considered a capital gains. It fell under this particular act. Really interesting strategies here for people who choose to use it. Okay, to calculate capital gains, and this is going to be one of those type things when you get ready to study for the exam, just go back and remind you of this, because since it's not a test question, it actually becomes a vocabulary question. So here's how we calculate capital gains. Your basis, your tax basis on your house is what you had in it when you purchased. So in other words, it's the sale price and your qualified closing costs. For example, when I acquired my house, I had to pay the $200,000 for the house, but I also had to pay certain closing costs such as appraisals and things like that that were required by the bank. I can actually count that towards my basis. So my basis is not really 200. My basis is actually more like 203 or something like that. During the time I've had the house, I actually did a capital improvement project in my master bathroom. We ripped it out, we redid that. In other words, it was more than maintenance. Capital improvements are something you did to make the house more valuable. Maintenance are things that you did to use it on a day-to-day basis. If I were going to ask you one trick question at all, it would be about the difference between capital improvements and regular maintenance. Capital improvements is adding or replacing a system. If I add a roof, that's a capital improvement. If I replace a couple of shingles, that's just maintenance, all right? If I add an HVAC system, that's a capital improvement. If I just have somebody come out and do an annual service on my air conditioning, that is not. And then also you could add to your basis special assessments. If the city came and brought me water and sewer and charged me $12,000, I could add that. So notice that the adjusted basis, and the adjusted basis, this could be a test question right here in this chapter, just the definition of adjusted basis. Your adjusted basis is your basis plus capital improvements plus special assessments. I've already told you one of the tricks in this question. One of the tricks is they may throw a repair in there and try to trick you into thinking that that's a capital improvement. It is not. The other trick, and pay close attention to this just real quickly, notice that discount points have nothing to do when you're calculating capital gains. So if you're dealing with a capital gains problem and they throw discount points at you, that's the trick. You just found it, okay? So anyway, you have some of these on your practice exams as well. So keep that in mind. I don't tend to think that they test you very, very deeply on this. When you're figuring your capital gains, now that you know your basis, then you figure out how much your amount realized is. And what I mean by your amount realized is what did you sell it for? Okay, what did you sell it for, and minus the closing costs like the commission and stuff like that. That's your amount realized. To the IRS, I want my basis to look as high as possible, and I want my amount realized to look as low as possible. And the reason is because amount realized minus adjusted basis equals capital gains. And so to the IRS, I try to make my capital gains number look as small as possible. For the most part, for homeowners, it doesn't matter because very few people make more than $250,000 in gain by the time you make these adjustments there. So that's that chapter right there. What can you write off your taxes? What is the capital gains treatment? A little bit of vocabulary here. My star just simply a couple of reminders of things I see pop up on tests every once in a while. Capital gains problems do not address discount points or mortgages. The discount points I mentioned to you, let me tell you what I mean about mortgages. When you calculate the amount realized, it really doesn't matter how much you actually put in your pocket. What matters is how much it looks like you made from the IRS standpoint. What you bought it for, what you sold it for. It has nothing to do with any mortgages. Capital gains questions have nothing to do with mortgages or discount points. And then just kind of as an FYI, we don't ask you a lot of questions about 1031 tax deferred exchanges, but if we do, it has something to do with the fact that it's a tax strategy for, watch this, investment properties, okay? In other words, 1031 has nothing to do with your home ownership. It only has to do with investment properties. If you own a home that you rent out to someone else, that would be the case. So, I mean, bam, we just knocked out, it used to be chapter 13. I can't remember what chapter it is now, but what's the effect of federal tax implications on home ownership? Boom, boom, 1 or 2 points there, okay? All right, now this chapter right here is going to be very unfulfilling from a review standpoint. And the reason is I can't tell you how important this is on the exam. I think there's probably about 14 questions on the national side of the exam that come from the real estate finance section. This used to be the easiest part of the exam, and somehow it has become the hardest part of the exam. The scores on this tend to run very, very low. So what I used to do is I used to just give everybody definitions, and I'd say, just go study these definitions, and you're going to be absolutely fine on the finance chapter. I still think that'll get you through half the finance chapter. The difference, I believe, is that today they want you to be able to do one drill down. In other words, not just what do VA loans mean, but what is their effect? How do they affect the buyer, the seller, the language that goes along with it? So as we're talking about these terms, what I'm going to try to do is remind you of the definition, but then I'll also talk about one drill down and how they might ask questions about these. Okay, so my first bullet point here in finance is know the difference between the parties to a mortgage and a deed of trust. Weirdly enough, although we use the word mortgage in North Carolina, that's not the way we collateralize property. We actually do it under a deed of trust. And do you remember that a deed of trust is a three-party instrument? And remember the names of the parties. There is the borrower, who is often referred to as the trustor. There is the lender, who is referred to as a beneficiary. And then there's a third-party trustee, who's always known as a trustee, by the way. And so what happens in North Carolina is when I borrow money and the bank says, hey, we want some collateral, but technically the bank doesn't hold it. What they do is they have me give it to this third-party trustee. So literally, during the time that I have my own and I tell people I own my home, I don't own my home because I've given it up to a trustee. Now, it's a conditional conveyance. Trustee can't do a thing in the world for it. They're only holding it in the event that I stop paying my mortgage. But that's the way it works in North Carolina. Don't become attorneys on this, but you do have to recognize the parties to the transaction. By virtue of the fact that North Carolina uses the deed of trust, we are known as a title theory state. You can see that's actually the second bullet point there. In a mortgage concept, there's only two parties. There's the lender and the borrower. In mortgage concept states, the borrower still goes to the bank and borrows money, and then the bank puts a lien on the property. Those are called, what are they called? They're called mortgage theory states. What are they called? Lien theory states. I don't have it on there for some reason. Anyway, for states that use the mortgage concept, they're lien theory states. Deed of trust are title theory states, of which North Carolina is a title theory state, okay? The purpose of the mortgage or deed of trust, just to remind you there, the property is pledged in exchange as security for a loan. It's collateral, if that makes it easier for you. Now, let me tell you what this bullet point right here is. Understand the difference between a promissory note and a mortgage note. This has actually been a question that comes up fairly often on the exam. It can sound like a trick question, but it's really not. The point they're trying to make here is that both of these are contracts. Promissory notes and mortgage notes are both contracts. The promissory note is just your promise to repay a debt. So for example, when I bought my car and I had a payment to them, I signed a promissory note. You sign the same thing when you purchase a house and you borrow money. So you sign an IOU, a promissory note. The difference between these two is that the mortgage note says not only do you owe money, but the property is the collateral for the debt. So think about this. The promissory note is just a contract to repay the debt. The mortgage note says if you don't pay the debt, they're going to come take the house. Okay, so important distinction there. Hypothecation. Most of us are in this situation with our houses. If you owe money to a bank, you are certainly in a hypothecation situation. And what that means is you get to live in the property even though you've given up as collateral for debt. So hypothecation describes a situation where the buyer, technically the borrower, possesses the property even though they have given it up as collateral for debt. Honestly, that is just a definition right there. If you see hypothecation come up, it would literally only be as a definition. I like this little section right here, and I actually like the way that I have it synthesized, and that I have all the definitions right here together. Clauses in a deed of trust, so know the word and know how it relates. So for example here, in no particular order, I'm not sure why I put them in this order, but it doesn't matter. Acceleration clause. All deeds of trust have an acceleration clause, and it basically says this. If in fact you breach the mortgage note, if you breach the note, the bank has a right to call the note due. So notice the words that I used here. Acceleration, you should associate with breach or default. Now, having said that, by far, the most common breach of a mortgage note is that you just don't pay it, right? And so if you don't pay it, then the bank has a right to call the whole note due. Well, I got to be honest with you. If you didn't make the last payment, if you haven't made the last 3 payments and the bank calls the note due, I doubt very seriously you're going to end up being able to pay the note off. Acceleration is kind of the kickoff to the foreclosure process. You don't necessarily have to associate it with that, but logic would dictate if they're calling the note due because you're not making your payments, there's a good chance you're getting ready to get foreclosed on. The way I remember the word acceleration is when they loaned me the money, I had 30 years to pay the loan off. But because I didn't make my payments, they accelerated the note and said, you got to pay it off now. That's where the word comes from, okay? Prepayment penalty is somewhat obvious. I don't want to spend a whole lot of time on that other than to say this. If you pay off your loan early, you have to pay a penalty. And the logic for this is simply that the investors who buy these notes, they collect so much money in the early years of these notes, they honestly don't want you to pay them off in the first 2 or 3 years because they're making so much interest during that period of time. So prepayment penalties are usually in the early years of the loan. The reason you don't hear about them much today is most loans we deal with don't even allow them. VA, FHA don't allow them. Loans sold in the secondary market don't even allow these, okay? Prepayment penalty, pretty straightforward. The due on sale or alienation clause, now keep in mind, alienation starts with A, acceleration starts with A. Make sure that you can differentiate between these two. And the difference is on the alienation clause, the bank can call the note due, but in this case, they're calling the note due because you sold the house, because you sold their collateral. Now, this is one of those drill down situations right here that I described to you in class. The due on sale clause basically makes a loan unassumable. So when you start thinking about it, most loans today have an alienation clause because most of them are unassumable. But there's 2 loans that we talked about in our class that are assumable. FHA and VA are both assumable loans. Well, what that tells me is if they're both assumable, then they don't have an alienation clause. And so that's the kind of, reverse thinking that you have to do in this chapter to really, really narrow down and get all the points. Clauses in a deed of trust. Hey, if you sell the bank's collateral, you got to pay them off. The new buyer cannot assume that loan unless the bank gives them the right to do so. Defeasance clause. Defeasance clause is actually in all deeds of trust, and you guys will recognize this easy. In a defeasance clause, when I pay off my loan, I do not want the bank to have the right to have my house as collateral. So defeasance clause basically says when I pay off my loan, I am entitled to have the deed of trust canceled. So it's no longer on the public record. So borrower has right to cancel the mortgage or deed of trust when the underlying debt is paid off. You have defeated the loan. That's the way I think of it. And then the power of sale clause, this is why North Carolina is actually different from a lot of other states. And to be honest with you, it's about 50-50, deed of trust states and lien theory states. But in deed of trust states, if the lender calls the note due, basically what they're going to do is they're going to call up the trustee and they're going to say, hey, go sell that on the courthouse, go sell that property on the courthouse steps and get us our money. The borrower's not paying us, so go get our money. That's the power of sale clause. Now here's the drill down on that. States that use the deed of trust, they actually are non-judicial in regards to foreclosures. And what I mean by that is this is not going to be a long case. When the bank calls the trustee is going to go to the clerk of court. They're going to file an administrative proceeding at the clerk of court's office, and they've basically won at that point. The only question at that point becomes, when are they going to auction off the house and get the bank's money for it? So power of sale gives the trustee the power to sell the property on the courthouse steps. Two things about mortgage priorities, neither of them very hard here, except that you guys have to remember the Connor Act longer than most of my classes I do. I doubt very seriously today if I asked a real estate agent in the field if they remember what the Connor Act was, that they would not know because it's a short-term memory thing. But the Connor Act is the act that said North Carolina is a pure race state in regards to recording of deeds, which means the first one to win the race to the courthouse has priority. And then what you're supposed to remember for test purposes is that there are some things that defy the Connor Act. For example, taxes always jump to the top of liens. And then remember, mechanics liens can actually jump other liens because they have special protections. But otherwise, Connor Act says first one to the courthouse, record it. That's how you get your priority. Oh man, I'm going to tell you guys a story because y'all are smart enough now that you can actually kind of understand this. We're dealing with a situation right now where someone purchased a home on they purchased a foreclosure on March 12th. It settled on March 12th, but it was not recorded until April 1st. Do you guys have any idea what happened between March 12th and April 1st? COVID struck. And when COVID struck, they suspended all foreclosures. So that guy, by not recording on March 12th, he now cannot record on April 1st because the rules associated with COVID, no foreclosures. That guy was an investor. He bought the property to flip it. Now he can't sell it. The reason he can't sell it is because he doesn't own it. He, on the public record, he is not shown as the owner of our record. So when we talk to you about recording, closing actually is defined as date and time of recordation of our deed. That guy's going to get screwed by the Connor Act because he didn't do what he should have at the time he bought the property. When the guy told me the story, I said, man, what a weird set of circumstances that he screwed because he did not record in a timely manner. I'm sorry, I thought that was an interesting story. Nikki, did you think that was an interesting story?
I did.
Okay, good. I've had y'all muted too long. I forgot. I was just sitting here talking to myself, and I forgot to unmute y'all from time to time. Well, thank you for playing along, Nikki. Okay, and then finally, subordination. To you guys, it's just a vocabulary word. Subordination is voluntarily allowing someone to jump in front of you. You know, in most cases, someone's not going to allow a lien to jump in front of them. I don't know if you remember this from class, but a lot of second mortgages actually have a subordination clause. That way, if somebody wants to refinance, the first mortgage can go to the front and they can stay there in the second position and collect that big fat interest that comes with being in second place. Oh, matter of fact, Charles, I can see you on the screen as well. So you get this next question here. This is a logical question, so you'll have to work through it logically. Typically speaking, and again, when weird things happen and interest rates go crazy, that's not typical. But typically speaking, which would have a higher interest rate, a first mortgage or a second mortgage?
Second.
Why? More what? More risky?
Yeah.
Yeah, because of the risk on that. And so that's why second mortgages, a lot of times they'll say, we don't want to be paid off. We're getting paid 8.5%, while the first mortgage is getting 4%. Don't pay us off. Keep paying us 8.5%, and we'll be happy with that because they're more risky. Okay. The other question that comes up sometimes for test purpose on that is, not only is it more risky, but oftentimes they're of shorter duration. Usually second mortgages are maybe 15 years tops or something to that effect. That it's not perfect, but it's, if the question is typical, then that's fine. Okay. All right. Thanks, Josh. Okay. Questions or comments so far? Okay. All right. Now then there was this little section that we got into this chapter where we talked about financing methods, conventional versus FHA and VA. And realistically, what you're looking at here is when would you use these, who would use these, and then what are the things that make them distinct. So for example, there's nothing really distinct about a conventional loans. I tend to think that your conventional loans are your stronger buyers, higher down payments, blah, blah, blah. Now, that's not always true. There are a lot of people who use VA loans who could get conventional loans, but they say, you know what? I like the zero down and I like the super low interest rates. And you know what? That's fine. So anytime you have a buyer that qualifies for multiples of these, make sure that the lender, you know, tries all of them to see which one is the best fit. But typically speaking, conventional loans are going to be larger down payment loans. Interest rates are going to be usually good because you're your higher credit score borrowers. And the vocabulary that comes up, and notice I say here, no participation by an agency of the federal government. When we get to VA and FHA, notice how the federal government participates. When we talk about conforming loans just mean that they conform to Fannie and Freddie standards. There's a software program out there. You'll hear us in the field, you'll hear the concept of underwriting. When they're going through underwriting, what they're doing is they're taking these borrowers, they're plugging all their information into a computer, and it's going to spit out whether they qualify or not. Really what it's saying is, do they conform to Fannie and Freddie standards? Because remember, Fannie and Freddie are secondary market institutions. If they conform to those standards, the bank knows they can make the loan because they've got an investor that's going to buy the loan just as soon as they make it. So conforming loans conform to Fannie and Freddie guidelines. Those guidelines typically talk about qualifying ratios. They limit the seller contributions. They'll actually have maximum loan amounts you can't go above. But if it falls into that category, it's a conforming loan. Typically speaking, conventional loans are your larger down payment loans, but hey, conventional loans will make you a loan with only 5% down. However, if you put less than 20% down in conventional loans, you're going to be paying private mortgage insurance. This is our rule in this class. Don't worry about the fact that when you get in the field, there are much more creative loans and lenders can do some really cool things. In this class, this is the rule. If you don't put 20% down, you're paying private mortgage insurance, okay? And then interestingly enough, when you get to the words insured versus non-insured, normally you think of insured as being best, non-insured, not so much so. When you're talking about loans, it's actually the opposite. Insured loan just simply means you made less than 20% down payment, so you didn't have to buy mortgage insurance. If you're non-insured, well, actually that's a good thing. That means you have a lot of equity in the loan. In other words, the lender's not worried about you. If you get foreclosed on, you got enough equity that you're going to be fine. They don't have a reason to buy an insurance policy on you. And then finally, when we talk about non-conforming loans, non-conforming, it doesn't mean it's a bad thing. It just means that it doesn't conform to Fannie and Freddie standards. So for example, heck, I love to work with people that get jumbo loans. It means they got a lot of money. They're buying a big house, okay? They got a big mortgage anyway. Whether they have a lot of money or not, I guess they'd have to qualify. But anyway, jumbo loans are not necessarily bad. They are just above the conforming standards. Now, subprime is bad. When I say that they're bad, these are people that have lower credit scores. Maybe they've had bankruptcies or short sales in their past or something like that. But you know what? There's still loan products out there. They've got their stuff straight and they can afford to buy a home now. They're just going to pay higher interest rates probably because they are less than prime, so to speak. Vocabulary there, but remember, also compare conventional loans to why it's different from these two. So let's get started on FHA. FHA, Federal Housing Administration, of course, administered by HUD, all right, an agency of the federal government. However, I want you to notice this first bullet point right here, and this is probably your most important bullet point on FHA. This is a government insurance program. Now, you have seen in your test bank questions, we were probably fairly brutal about this, is that FHA is a government insurance program. The government does not provide the money for the loan. The government doesn't even tell banks what the interest rates should be. What the government does is said, hey, if you'll loan money to this guy right here, then we will insure the program. Now, let's talk a couple of things about that. First of all, why does this program even exist? The purpose of the FHA program is to make home ownership available to more people. Well, how does it make it available? Lower down payments. Think 3.5%. Lower credit scores, maybe a 660 instead of a 680. I mean, it can't be real low, but it doesn't have to be quite as high as conventional. It opens up the number of people that can borrow money. And you say, why would the government insure the program? Well, everybody in the FHA program pays mortgage insurance premium. So in other words, the taxpayers don't pay for this program. The people that are in the program pay a mortgage insurance that covers that, because we know there's going to be a higher default rate because these people have lower credit scores and they put less money down. So they pay for their insurance as they go. Because this was designed to make homeownership more viable, these loans are only for owner-occupied properties. The FHA loans are for only owner-occupied properties. Now, you can get a little bit creative. If you wanted to buy a quad and live in one of the units, that's fine. That's fine. But you literally have to occupy at least one of the units. And you can't buy greater than a quad. You couldn't buy an apartment building with these. Let's see. Lenders and appraisers must be FHA qualified. It's an interesting bullet point. Probably not where they're going to test you, but that's okay as well. So what's the difference between conventional and FHA? The fact that the government participates by providing an insurance program. The borrowers pay a mortgage insurance premium in the event that someone else in the program ends up being foreclosed on. Okay. Similarly, but specifically different, the VA program. Again, how are they similar? Well, the way they're similar is this is a government program. How are they different? They're different in various ways. FHA and VA are different in several ways. First of all, let's see if I can find the right word. Second bullet point here. The VA program is a government guarantee program. Now, for test purposes, don't worry about the distinction about what's the difference between an insurance and guarantee. I promise you, insurance goes with FHA and guarantee goes with VA. That's the extent of what you need to know for test purposes, okay? So now, obviously, we won't get into too much detail about this, but this is clearly for veterans, active military, and I've been told that you do need to know this bullet point right here as well. There are certain spouses, unremarried spouses of a deceased military person also can qualify for this as well. Don't worry about getting into too much detail. Just be aware of that factoid, okay? The VA determines the entitlement and eligibility. Now, having said that, keep in mind, what the VA is basically telling you is what the veteran's eligibility is. When did they serve? How much did they serve? Where did they serve? How much is their eligibility? But the lender will determine how much they'll loan you. So in other words, you could have your eligibility could be a lot higher than what you qualify for with the lender, okay? And what happens is the lenders don't actually set a maximum house price. What the lender sets is a maximum loan amount because it'll be a factor related to your eligibility is what it amounts to. A couple of words that are peculiar to VA loans. CRV, if you ever see CRV, it stands for Certificate of Reasonable Value, and you can see my note at the end. It's essentially a VA appraisal. And the thing that's interesting about that is just simply the fact is you have to be qualified to be a VA appraiser. A lot of appraisers are, don't get me wrong, but you actually have to be qualified to do VA appraisals. I have often referred to them as being really close to an appraisal and an inspection because VA appraisers are very, very tough on things like deferred maintenance, peeling paint, lack of flooring in one of the bedrooms or something to that effect. So CRV, Certificate of Reasonable Value, it's a VA appraisal. That's what it is. And a VA funding fee. Now, keep in mind, the VA program is a program that we support with taxpayer dollars. This is a benefit to our veterans. However, veterans that are in the program pay an upfront one-time funding fee. It can be rolled over into the loan if they choose to do that. So in other words, VA program doesn't have mortgage insurance. What they have is a funding fee. It's always also interesting to note that disabled veterans may be able to avoid this funding fee. I tend to find that that's more useful to know in the field than for test purposes, but this is a hugely valuable program right here. If you're ever dealing with a veteran, they should absolutely look at this program and see if it makes sense for them. What's the main advantage? Zero down financing, and then preferable interest rates as well. Let me tell you why this is a bullet point. Now listen closely to this. It may come up, it may not come up, but understand the idea of leverage. If I were to ask you which of these loans has the greatest leverage and why, your answer is a VA loan, because you can't get better leverage than 100%. FHA was 3.5% down. Conventional was probably minimum of 5% down. So if you ever get a test question, say which loan type allows the greatest leverage? Well, you can't get better leverage than 100%. So it would be the VA loan. You know, this is another interesting factoid. Occasionally somebody tells me this pops up on the exam, but I can't imagine it's the right answer. The VA does not make loans. What the VA does is they guarantee loans. You go to your regular bank to get these loans, but this last bullet point just simply says, you know what, if there's not a bank locally that deals with VA loans, then go directly to the VA and they will make that loan directly. But that is a rare circumstances where they would deal directly with the VA loan. Okay. All right. So boom, there's a little section right there. Conventional versus FHA versus VA. You know, I'm thinking a couple of questions out of that little section alone. How do they compare? Do you understand the words guarantee? Do you understand the words insurance and how they relate to the appropriate loans? VA loans, just like FHA, are for owner-occupied properties only, 1 to 4 unit dwellings. So they have a lot in common, but they have distinctions as well. All right, questions or comments on that? Feel good? Okay. Now this next section, here's good news on this next section. This is clearly just vocabulary. So we'll fly through this, and the reason we'll fly through this is just simply because of the fact that all I'm going to say is what's already on the screen. When we start talking about loan types, I just need you to understand the definition of it. Fixed rate loan, very simple. Okay, your rate's going to stay the same over the course of the time that you have the loan. Now, one thing that's tricky about a fixed rate loan has nothing to do with the loan itself. But oftentimes I tell a buyer, say, well, okay, you're getting a fixed rate loan. Your payment's going to be the same throughout the course of the loan. And then they'll call me up next year and they'll say, hey, my loan went up. Well, their loan didn't go up. Probably what happened is they had a loan where you paid not only the loan, but you also pay your taxes and insurance escrows within the loan. And what happened is your taxes or your insurance went up. Well, that had nothing to do with the loan. So fixed rate loans, pretty straightforward. I can actually predict how much interest you'll pay over the life of a loan when it comes to a fixed rate loan. Give you something to compare it to. An adjustable rate mortgage is kind of the opposite of that. An adjustable rate mortgage is going to adjust at various terms. If it's a 1-year loan, it's going to adjust every year. Not a 1-year loan, excuse me, a 1-year ARM, then it's going to adjust every year. If it's a 7-year ARM, it's probably going to adjust for the first time in 7 years, and it may adjust every year after that, depending on how it's set up. It's an adjustable rate. Why would people get adjustable rates? Well, they would get them because they have a lower upfront, what they call a teaser rate. That's why people get adjustable rates. And then you say, well, what's the downside of an adjustable rate? Well, it adjusts. So what's going to happen if the economy improves and then the interest rates start going up? Your adjustable rate mortgage is going to go up as well. Okay, so kind of know the advantages and disadvantages of those. And this should make sense to you as well. In an adjustable rate mortgage, I can't tell you how much your interest is going to be over the life of a loan. You know, that's a truth in lending concept, but I can't tell you your interest over the life of the loan because I have no idea what your interest rate is going to be in 2, 3, 5 years down the road, whatever. Okay. A little bit of vocabulary here, understanding that in adjustable rates, that when a borrower borrows money, the lender can't tell them how much their rate will be in 5 years, but they can tell you how they calculate it. They will tell them what their margin is. They'll tell what index it's based on, and they'll tell how much it can go up or down in any given year. Those are the caps. Okay. Graduated, I actually mentioned this on Wednesday when we were together. Anytime you see the word graduated, think stair steps. Okay. So in a graduated payment plan, it's a loan that was designed so that in the early years, your payment was low, but next year it's going to go up. The year after that, it's going to go up a little bit. The year after that, it's going to go up a little bit. And the logic of this is it allows you to afford more up front, knowing that you got to catch up on the back end. Okay, but I need your attention on this one. If you get a question about a graduated payment loan, there's a real good chance that it's going to deal with the concept of negative amortization. The way they make the loans, the loan payment very low in the early years of graduated loan is you're actually paying, your payment is less than the interest that is accruing, okay? And so if your payment is less than the interest that's accruing, you're not paying your mortgage down. Your mortgage is going up, negative amortization. Negative amortization almost always happens in the early years of a graduated mortgage. And you say, why would anybody ever do that? Well, that might be all they can afford in the early years, but they know their job's going to pay more in future years. Or it might be an investor that's only going to hold the house for a short period of time. They don't really care if it adds a little bit, if they're going to make a good margin anyway. Term or straight term, whenever you see that, it just simply means an interest-only loan. And again, let your mind, think logically about this. If you have an interest-only loan, you're never going to pay it off if you only pay interest. So term loans have to be combined with I didn't even put it on here, a balloon loan. You might want to put that on there. Term loans have to be tied to a balloon payment. And a balloon payment means exactly what you think it should mean. A balloon payment, the last payment is bigger than the previous payments. What do I mean by bigger? Well, it's a doozy, because remember, you've been paying interest only. At some point, you're going to have to pay the loan off, okay? So term loans, interest only, balloon payment, the last payment is going to be big. It's either going to be all or you're going to refinance at that point. Construction loans, again, they mean what they say, but there's actually some interesting points that come out of a construction loan. Construction loans, obviously, are loans that you would take out to build a house. Builders do this all the time. You could do it as well if you want to build a home and you qualified on it. But the thing about a construction loan is if you ever get a test question that leads you to believe that what they're looking for is the most risky loan type, construction loans are the most risky loan type. Because part of the time, the collateral's not there. I mean, you borrowed money and there's not even a house there. Then you put in a foundation, you went and borrowed more money. Well, the framing's not there yet. So that's why these are considered high risk. Weirdly enough, commercial banks love construction loans. And the reason that they do, because they're high risk, they can charge higher interest. And most construction loans are paid out in a year because you only use them to build the house. Once you finish out the house, you get what's known as a takeout loan, which will convert it to usually some type of 30-year fixed product or something to that effect. So construction loans, they have subsequent draws. You don't take all the money at once. You take the money incrementally. I need to pay my foundation sub, so I'll take a draw. I needed to pay my framers, I'll take a draw. I need to pay my roofers, I'll take a draw, and I'll pay them off. So I'm only paying interest on the money I've borrowed at any given time. Construction loans. Buy down loans, it's hard to write a test question about a buy down loan without using the word buy down, okay? But what's happening in a buy down loan is someone is temporarily prepaying interest, and usually they're buying it down for just a short period of time. If I were going to give you any hint at all on buy down loans, and I don't even know if it'll show up or not, but buy down loans and discount points are very, very similar. The distinction is that buy downs are usually for a short period of time, but you buy the rate way down. You buy the rate down from the example I gave you in class was buying it down from 6% to 4%, but you only did it for 2 years, okay? Whereas a discount point, you buy the loan down very, very little, but you do it for a long period of time. But they're just prepaid interest, that's all. Other terms that you might want to be familiar with, open-end versus closed-end mortgages. I don't have it here in my notes. You want to write it in. A HELOC is the best example of an open-end mortgage. HELOC, home equity line of credit. Why is a home equity line of credit an example of an open-end mortgage? Well, what happens in an open-end mortgage is you can borrow money up and down within a credit range. That's the way most home equity lines work. Chris, here's your $50,000 credit line. If you want to buy a Lexus tomorrow, go out and write a check for it. That's fine, okay? As you pay it down, if I then want to go out and buy, I don't know, a tent or something, then I could go and borrow more money. And so it goes up and down as long as I stay within that credit line. And obviously, on a HELOC, I'm paying interest on whatever I have borrowed at any given time, and they have a lien against my house. That's open end. Your first mortgages are closed end. They only go in one direction. If you want more money in a closed end mortgage, you're going to have to refi. Package mortgage, it's a definition for you. It's just a definition. A package mortgage is a mortgage that includes not only real, but also personal property, okay? And then blanket mortgage, technically it's just a definition to you as well. A blanket mortgage is any one mortgage that involves multiple pieces of property. The example is that a developer often would have a blanket mortgage because when they bought the property, they had only one property. And then over time, what they did is they divided it into multiple properties. So that one mortgage covers now 100 different properties. Carly's going to be taking, she said it was private, but I'll tell you as well, because all of you may have this question. She's going to have to jump off at 11 o'clock today. But what she asked me was about the math review. I'm running a little bit behind on the math review, so it will probably be later this weekend before you get that. And because it's later this weekend, I want to give you about 4 days to do it. So assuming, Carly, and I'll send you an email like you asked, assuming that we finish this up today, what we're going over today, then we won't meet on Wednesday, but we'll meet on Friday to do the math review. That'll give you 4 days to actually work on the math review. So that's the logic behind that.
Okay. And
Okay.
you'll email that to us when it's
Yeah, I'll email that to everybody that's in the class, whether they've been on this or not. And remember, what I'm doing on that is I'm just seeking other instructors. I'm saying, look, guys, let's get together and figure out how can we synthesize this to the most important things and make sure that you guys have a good, accurate understanding of what you're likely to be tested on at the state level.
Great. Okay. Thanks.
Okay. Thank you, Carly. Okay. While we're paused here for just a moment, let me remind you again, do your studying in blocks. I got to be honest with you. When you're doing your study in blocks on loan types, at some point you're going to know those so well, it's not going to be worth you going back and studying because it's just vocabulary, okay? So study in blocks, and as you get things, just set them aside, say, I've got this for permanent recollection. Some of this stuff, when I teach it, I don't go back and study it ahead of time because I know it so well. There's other things that I always have to study because there are changes. This is not one of those loan types. It's definition, it's flip cards, learn it, move on, get involved in some of the other stuff. Any questions on loan types, loan terms? Okay. Similar here, we're now getting ready to start a block on the secondary mortgage market. Okay. So we're going to talk first of all about the difference between the primary market and the secondary market. And the simple difference is this. The primary market is where you go. If I were to ask you, where are you going to go to try to get a mortgage? Whatever you would name would be a primary market. You'd either say a credit union, you'd say a mortgage bank or mortgage broker, excuse me. You'd say your commercial bank that you bank with. These are all examples of primary mortgages. That's who consumers deal with. The secondary market, remember this question, the secondary market is actually where the money originates. And what I mean by that is when I go to Wells Fargo to borrow money to buy my house, think about it. If 10 people walked into Wells Fargo today and borrowed $500,000 a piece, Wells Fargo would run out of money because they don't keep that much in their vaults at any given time. So what they do is they create a mortgage and then they sell it in the secondary market. In the secondary market, because it's tied to Wall Street and investors investing in mortgage-backed securities, it has an unlimited amount of cash available. That's the secondary market. And then the primary secondary market players are Fannie Mae and Freddie Mac. And then notice what we do down here is I just give you like 2 or 3 bullet points that have to do with either one. Look, unless you plan on becoming the head of the Fed, you don't need to get into too much deeper understanding of these. But I do think you need to recognize the terms. Here's the other thing I think they do to you on the test. They play with terms. So in other words, they may ask you a test question about a loan, and they may say, who do you go to get a loan? And among those options, you may have the FHA, you may have Fannie Mae, you may have somebody else, you may have your local bank. Well, out of those, the only one that I mentioned that was correct is your local bank. So you don't go to FHA to get a loan. You go to a lender who is an FHA qualified lender. You don't go to Fannie Mae because Fannie Mae is a secondary market institution. That's the level that you need to know this. So it's not hard. You just need to be aware that that's the type of question they're going to ask you. Okay. Now, we get into the secondary market institutions. Fannie Mae, it was the oldest because it's still around and it was the first created. Today, it's actually in government receivership, but having said that, it was designed to become a private entity where people would just invest in it. Stockholders would invest in it. It purchases all three mortgage types. And what I mean by all three mortgage types is conventional, FHA, and VA. Fannie Mae can purchase anything. That's what it was originally created for. As time passed, we realized we needed other institutions other than just Fannie Mae for competition purposes and also to cover the market. So out in the 70s, not important, this is not a history exam, but Ginnie Mae was created. Now, Ginnie Mae, notice that it only buys FHA and VA loans. In other words, government loans, Government National Mortgage Association. So that's a factoid. Technically speaking, Ginnie Mae doesn't even buy loans. What Ginnie Mae does is they offer pass-through certificates. Now, again, rather than you understanding the process, I just want you to relate pass-through certificates with Ginnie Mae's. If you want to know, pass-through certificates basically are certificates that give institutional investors the right to buy Ginnie Mae loans. So FHA and VA loans. I'm trying to think of any other twist on that. The only other twist that's kind of interesting about it, and this is completely understandable once you hear it, Ginnie Mae will not guarantee an investor that they're going to get a return on the money, but Ginnie Mae will basically say Ginnie Mae's will always have a value because remember, they're backed by the federal government, FHA loans insured, VA guaranteed. So as long as there's any value to the good faith and credit of the federal government, Ginnie Mae's will always have some credit, some value. And then finally, the Federal Home Loan Mortgage Corporation, the only couple of important points here, I wrote both of them down. It was created to purchase conventional loans. In other words, to provide another outlet from Fannie Mae for competition purposes. And then it was actually created for the savings and loan. That's where it got the name, Federal Home Loan Mortgage Corporation. It was actually designed for to buy conventional loans from the savings and loan industry, from the S&Ls. Okay, so not a hugely valuable group right here. I'm thinking maybe 1 point. It would be a matter of fact. It literally could be 0. So we're only looking at about 1 point here. So stay topical, stay level 1, and move on. Otherwise, this will make your head hurt. Okay. Truth in lending is exactly what it says it is. Now in class, here's the way I normally talk about truth in lending. I say that this applies to makers of credit. That's called truth in lending. It applies to makers of credit. Real estate agents are not makers of credit. So when I start thinking about how they're going to test you on this, I think, well, they shouldn't go very, very deep. Now, just because I say they shouldn't doesn't mean that they won't. But I start with the obvious and I work backwards from that. So what I mean by starting from the obvious and working backwards is there is a way that truth in lending actually affects real estate agents, and it has to do with advertising. Do you remember this from class? Advertising, trigger terms. If I advertise any specific finance term, I must in fact fully disclose the terms of the loan. So to me, that's a legitimate question. That's actually a fair question because it does affect you as a real estate agent. We have great questions on this in your finance section, so make sure you're going back and studying them. The more difficult ones, if you miss them and you can't figure out why you miss them, feel free to shoot me an email, but I got to be honest with you. If we're asking you a super hard question on truth in lending and you can't figure it out, it's probably above the level of the test. The other thing I do think is interesting about truth in lending is the fact that it's only for properties that, notice my applicability here, it's only properties where the borrower's residence serves as the collateral for a debt. So in other words, if they ask you a truth in lending question and they try to make you think that this affects business loans, it doesn't. It doesn't affect commercial loans, has no effect on commercial loans whatsoever. Why? Because they're not collateralized by your residence. In other words, this is a consumer protection, right? And so it's designed to help people when borrowing money against and using their home as collateral. Fair Credit Reporting Act, read it and then move on. It is what it says it is. Fair Credit Reporting Act, how can people use your credit once they've pulled it? It also tells you if someone puts something on your credit report and you don't agree with it, what's the dispute proceeding? You've heard that before. That's because of this act. And Equal Credit Opportunity Act. I want to slow down for just a minute on the Equal Credit Opportunity Act. And the reason I do is I don't think they would go this route. But the fact is, if they asked you a question that had you make the distinctions between fair housing and the Equal Credit Opportunity Act, I do think that's worth studying. Do you remember in fair housing, there were 7 protected classes, fresh corn? Well, the Equal Credit Opportunity Act has most of those same classes, but there are a couple of differences. For example, age is not covered in the Equal Credit Opportunity Act. Okay, so in other words, I'm sorry, let me rephrase that. Age is recovered in the Equal Credit Opportunity Act. It's not covered in the Fair Housing Act. And then instead of familial status being covered under the Equal Credit Opportunity Act like it is in fair housing, marital status is covered. And the way I tell people to remember that is, keep in mind the Equal Credit Opportunity Act, this goes back to the 70s when it was not uncommon for someone to ask a single woman, where's your husband? How are you going to qualify for this? Okay, so that's why that protection is in place under Equal Credit Opportunity Act. So what's my short version of that? Compared to Equal Credit Opportunity protections next to fair housing, you win if you can get it to that level. All right, let me pause for just a second again to see if there are any questions. I've done most of the talking today. So did anybody chime in? Jackie, I'm coming to you. How's it going this morning, Jackie?
Good.
Good. Can you hear me okay today?
Yeah.
You seem to have much better reception, so that is
Yeah.
awesome. Good, good. Patty, I see you down there today. You've been very quiet. How are things going today?
Good. Taking notes.
Taking notes. Good job. Good job. You ready for the test yet? What do you need to get you ready?
I'll just keep studying. That's it.
Okay. Okay. All right, guys, don't forget, ask me if there's something that I can provide that will help you. Look, I'm going to take a short break right here, but it literally is only going to be 4 minutes. We're going to be back at 11:05 because we're only going to 12. So go get yourself something to drink or whatever and be back at like 11:05, 11:06 at the latest, and then we'll knock out these last few chapters here.
Okay.
Zoom recording. So we're back on for that. And let me hit the mute button. You are all now muted. If you would like to get in and ask a question, don't forget to hit your space bar. Okay. There was this little chapter in the book about closing the transaction, and actually it wasn't a little chapter at all. It was kind of long because it did go through the whole closing, contract to closing point. And I think the most important thing about that chapter, we literally didn't cover it as a chapter. What we did is referenced it because so much of this other stuff came up in other chapters. For example, you're going to get tested on closing the transaction. You're going to get tested on your prorations. So clearly part of your math review, I will revisit this with you. I'm not going to waste a lot of time on it right now, but if you go back and start practicing, prorations of taxes is absolutely something you're going to need to know for the exam. So be prepared for that. Let me get Patty back in. Okay, yeah, she's back. Okay. Also in this chapter, because it was talking about closing the chapter, closing the transaction, this is also where you get into the Real Estate Settlement and Procedures Act, RESPA, Real Estate Settlement Procedures Act. And basically the purpose of this act, remember, just like truth in lending, RESPA is a consumer protection. And in regards to RESPA, the purpose of it is to fully inform borrower of their settlement costs. So if any of you have ever purchased a home, and depending on how long ago it was, you may have gotten either a HUD statement, they call it a HUD-1. Today, it's actually called a CD, a closing disclosure. It's a little bit different today, but they still show the same information. What it basically does is it itemizes where your money went. How much did you pay the attorney? How much did you pay for closing costs? How much, I'm sorry about that, Gus. So anyway, it literally itemizes what expenses you pay. Why? Because consumers should know how much it costs to get a loan to buy a house, et cetera, et cetera. So that's the purpose behind RESPA. How do they do that? Well, the way they do it, they give you a good faith estimate of your closing costs. The lender gives you a good faith estimate of closing costs. If there's any bullet points that I want you to remember about the RESPA and the good faith estimate, today, it's actually called a loan estimate. They no longer call it a good faith estimate. They call it a loan estimate today. And it should be given to the borrower within 3 days of your loan application. Just as another kind of FYI, remember, these are the laws, the Truth in Lending and RESPA are the laws that are referred to as the know before you owe, KNOW, know before you owe. The idea is between Truth in Lending, which talked to you about what your annual percentage rate was, and RESPA, which itemized what your closing cost is. Consumers should know exactly how much they're paying for the money and where the money went in a transaction. Now, also, while you're making a note here, don't forget to put in, if you ever see, how is it worded on the, I'll come back to it in just a second. But today, Truth in Lending and RESPA are combined. So you'll have your loan estimate, you'll have your closing disclosure. So from the time you got your closing estimate and close, you'll be able to look at it and compare it. This is how much I was told that the loan was going to cost, and this is how much it actually costs. Compare those two, and that's how it's consumer protection. There's a settlement cost brochure. The settlement cost brochure, you won't need to remember a lot about it, other than the fact the lender provides it, and it tells you what your loan costs are. So in other words, if we were to say that there's a $500 underwriting fee, they describe what the underwriting fee is. If they tell you there's a tax service fee, they tell you what the tax service fee is. It just describes what these words mean. And then finally, the RESPA also requires that you have a closing disclosure at the end. And you should have that closing disclosure 3 days prior to closing, so that the buyers actually get a look at it and compare it to their loan estimate to make sure that they got what they paid for. RESPA is also the law that prohibits kickbacks between settlement service providers. So let me remind you what this looks like if it shows up on the exam. As a real estate agent, I'm not saying you can never take kickbacks. For example, if in fact, I don't like to call it a kickback, but if in fact I recommend Joe's carpet service and Joe pays me $200 every time I recommend him, I can accept that as long as I tell the client that that's what's going on. But when it comes to settlement service providers, attorneys, title companies, inspections and stuff like that, I can't even receive it, because if I do, it's driving up the borrower's cost. And so under RESPA, they say no kickbacks in the settlement service process. I doubt seriously that they're going to get this specific about it, but it's okay for a lender to come to my office and buy everybody in the office lunch. That's fine. That's marketing. What a lender cannot do is a lender cannot come into my office and say, hey, Charles, if you give me a loan this month, I'll send you on a trip to the Bahamas, okay? Because that is a kickback tied to a specific transaction. It's beyond marketing. It's tied to a specific transaction. That is where the illegality comes in. No kickbacks between settlement service providers. Matter of fact, I'm looking at my note now. You should insert the word settlement between these two words right here, between settlement service providers, okay? Also, a vocabulary word comes up right here. The Good Funds Settlement Act. If you ever see this, the Good Funds Settlement Act has to do with the fact that no disbursements of funds should occur until closing. Now, let me remind you, let's tie three things together here. Good Funds Settlement Act, attorneys, don't disperse funds until it has been until it's closed. Now, remember, closing, according to our contract, means recording of the deed. So you can see what I put here. Don't disperse until you have recorded, okay? Good Funds Settlement Act, not really targeted at real estate agents, other than the fact that agents, you're not gonna get paid at the table. Why? Because the attorney cannot disperse funds until they've recorded it at the courthouse. All right, the valuation chapter. Now keep in mind, this chapter right here, go back and study it. There's actually a couple of reasons. One, there's a ton of questions on the test, probably 9 out of this chapter alone on valuation. The other part is I don't find them to be that difficult. Once you get real familiar with the language here, these tend to be fairly simple questions on the exam. This is a great place to get all 9 or 8 out of 9 of these questions right, and it'll help boost your score in other areas. Okay, so the first thing we do in the valuation chapter, now keep in mind, we as agents, we are not appraisers, but we steal a lot from the appraiser community. So the first thing this chapter did was define what an appraisal is. And notice that an appraisal is an opinion of value, but it's based on market facts. This has been a popular question in the past, is to help you understand what we mean by market facts. Well, what we mean by market facts is that an appraiser actually use closed sales. Why do they use closed sales instead of pending or active listings? The reason is a closed sale is a market fact, okay? We now know exactly how much somebody will pay for that house because that's what they paid for it and it closed. So it's an opinion, but it's based on market facts. To call something an appraisal, you literally have to be an appraiser. So what you and I do as agents, we don't call those appraisals. We call them comparative market analysis. We call them broker price opinions, but we do not call them appraisals because we're not an appraiser. And then, by the way, notice I have this in dark here. Agents can find probable sale price, but not market value. Market value is a word that is defined by federal law, and market value is what you derive in an appraisal. Well, we can't do an appraisal because we're not appraisers. So I know it seems to be semantics, but in this case, it is not. Agents find probable sale price. Realistically, I was dealing with a seller the other day, and what I did with the seller is I gave him a probable sale range. And the reason I gave him a range is I said, where do you see yourself on this range, seller? And obviously, they always say the high end. And when they say the high end, I go back to them and say, well, if you're going to be on the high end, you better have your house turnkey ready to go. It better be freshly painted. It better be freshly cleaned. It better be the best one on the market if you want to get the highest price. So agents, it's okay to give them a range and then let the sellers choose where they see themselves. If they don't want to do the work, boom, they're probably going to be at the lower end of the range. All right, definition of appraisal. Your bullet point on that was that be careful with your terminology. Probable sale price versus market value. Do you understand that? Okay. Then we get into this little section here where we're basically talking about the economic principles of value, and these are just vocabulary words. I like this for a test question. We used to get 2. I don't think they do 2 anymore. I think they only do 1, but it's worth knowing these definitions in comparison to each other. And the economic principles of value, Notice I didn't put a definition of supply and demand. Supply and demand is actually fairly understandable. The less you have of something will be more valuable if there's more demand. So in other words, I'm getting ready to list a house over in Durham, and in that neighborhood, there are 0 houses on the market right now. The reason there's 0 houses is every time they put one on the market, it sells within 18 minutes. There is a very low supply and a high demand. We're going to be able to push the envelope on the pricing on that home. On the other hand, if there were a ton of listings, then obviously the greater the supply and lower demand, it's going to hurt. So you can just logic your way through supply and demand. The definition of anticipation is, to some extent, buy or buy today based on future value. And what I mean by anticipation is, I'm buying a property today, but here's what I know. They're putting a new school nearby. They're putting a new shopping center nearby. They're putting a new park nearby. All of these things are going to lead me to believe that there's going to be greater value in the future by virtue of this. So yes, I'm paying today's dollar for it, but I'm buying it anticipating that there will be, I can't guarantee it, but I'm anticipating that it's going to have a higher future value. Now, here comes the first of your important words, and I hope I'm consistent on this with what we said in the when we were coming through the class. The economic principle of substitution, very, very important. And the reason is the whole concept behind the market analysis. In substitution, I described it in class as being the Walmart principle. All things being equal, people will buy the lesser priced item. Okay, so that's your definition there. Now, having said that, the reason it's the basis behind the CMA is, if I think my house is worth $400,000 and there's 3 others on the market for $350,000 and they're just like mine, well, people are going to buy the $350,000 houses before they're going to buy mine. So there's no sense in me pricing it at $400,000 if the market says $350,000. Economic principle of substitution. All things being equal, people will pay less for an item rather than more. It's the basis behind the CMA. Those are your bullet points on that. Conformity, yeah, a little bit of a long shot here. This used to come up on the test, but if it did, it was just a vocabulary word. The economic principle of conformity I refer to as the subdivision concept, because what it says is homogeneous or harmonious use of property leads to the maximizing of property values. And the reason I say it's the subdivision approach, if you ever drive into a subdivision and look at it and say, wow, that doesn't look overly creative. The reason it's not overly creative is because everybody's held to the same standards. In essence, they're holding each other's properties values up. You could say they're also holding each other's property values down, but I mean, that's okay, because in this area, there's a certain investment that they've made and they're trying to hold each other's property values up. Don't build a 1,200 square foot house. We put a minimum of 2,200 square feet here. That's the principle of conformity. Now, the other one you want to put a star beside is the economic principle of contribution. This is also important in doing your CMAs, which again, math problem, so we'll do it next week. Economic principle of contribution, here's why it's important. An improvement is only worth the value that it adds to a property. So it may cost me $20,000 to build my 2-car garage, but the market says it only adds $14,000 worth of value. That's the contribution value. I felt so bad this week. I had a client that bought a house last year. They bought a house and they went in and put in an upscale kitchen and they really decked it out nicely. They turned it into a beautiful home. They spent, I can't remember what the number was. They spent over $109,000 upfitting this home, and they put it on the market a year later. And they were asking me how much I thought these improvements were. And I said about 25% of what you paid. She almost slapped me when I told her that. But the problem with it was she over improved for her neighborhood. And so her contribution value, she's thinking that her house has gone up $100,000 in value. I said, no, your house went up about 25 to 30,000 in value, because I can't sell it for more than a similar house in the neighborhood. That's the principle of contribution, okay? All right, boom, you study those together, vocabulary, compare them to each other, understand how they work, one drill down. And then notice I mentioned market value a little bit earlier. Important definition here: the most likely price that a well-informed and typically motivated buyer will pay to a well-informed and typically motivated seller in an open market. That's a fantastic definition, by the way. Everything you need to know about market value is right there. That's what appraisers look for. That's why when appraisers are pulling comps, that they get rid of the ones that were distressed sales, or they get rid of the ones that were over improvements. Those are just not typical buyers and sellers. So they get rid of them and they deal with the people that are dealing in reality, so to speak. That's what appraisers look for, is market value. Granted, we as agents, we kind of look for that as well, but we never use that word. We use probable sale price or probable sale range. I don't know how this would come up on a test question, but just as a FYI, notice that the words price and cost may sound like they're synonymous, but they technically are not, because price is how much the market will pay on any given day. Does it make sense to you that when COVID-19, well, actually, let's use the stock market. That's a great example right there. The day that we announced the shutdowns, the stock market fell thousands of dollars. Those company values did not change that dramatically overnight, but what changed was the amount somebody was willing to pay for that stock overnight. That's the difference between price and market value. The market value on most of those companies is still relatively the same. The price somebody pays for them dropped dramatically on that day. And then anytime we talk about cost, we're just talking about what did you have in it to produce it. We agents don't get into that a whole lot. Builders do. I mean, this is where builders live. They live in this concept of cost. They base their margins based on what it costs for them to build it. Okay. Next little section here, again, just vocabulary, concepts of value. Excuse me. And concepts of value, I don't even know how we would test you on these. So just look over these from a vocabulary standpoint. Let me see if there's anything weird here. Demand, you understand that word. Value follows demand. If everybody wants what you got, charge them a lot for it. If nobody wants what you got, unfortunately, you're gonna have to drive your price down to where the market is. Utility, this is actually an important word. Not necessarily an important definition, it's an important concept. In this chapter, we talk a lot about items having equal utility. Now, that doesn't mean they're exactly the same. When I go out and find comps, I want to find comps that have equal utility. That's why I compare houses in my neighborhood to other houses in my neighborhood. I don't compare houses in my neighborhood to 12 Oaks, for example. 12 Oaks is an upscale golf course community. That's different from mine. Mine is a single family residential with a couple of amenities. It would not be fair to compare the two. They don't have equal utility, okay? So that's what we mean by that. Some people look at it and say, well, that house is not like mine. No, that house is not like yours, but it's in the same neighborhood, same size lot, same amenities, and it's a 3-bedroom, 2-bath. Boom, they have equal utility. Scarcity and demand go together. Obviously, the less of something that there is, it's going to drive the value up if there's a demand for it. And then transferability really was not as important in this chapter as it was in chapter 2. The importance of transferability is, I don't care how valuable you think your property is, if you can't transfer it to someone else, it has no value. Remember the story I told you a little bit earlier about the guy who didn't record his deed? He's in some type of weird limbo land where he can't convey his property because he doesn't have clear title on his property. His property has absolutely zero value to anyone right now. He's trying to sell it for 300 grand, but it has zero value to anybody until he works out his issues about transferability. Okay. I'm glad he came into my office. I got a lot of good stories out of him. All right, now we're talking about the approaches to value. Clearly, you're going to get tested on this. So not only do you need to understand the approaches to value, you also need to understand when they would most likely be used, okay? And the distinctions. And by the way, there will be a test question on a couple of these. So I'll let you, I'm sorry, a math question on a couple of these, which we'll clearly get to next week. So the sales comparison approach, also known as the market data approach. Now, let me remind you, part of the important part is knowing when to use it. And that's my first bullet point here. You would use the sales comparison approach on single family residential properties and vacant land. That literally used to be a test question right there. And the significance of it is, what's important about single family residential? Actually nothing, other than the fact that we had 60,000 single family sales in our area last year. So if I'm getting ready to sell my house, there's a real good chance I can find a similar sale. So the sales comparison approach is based on the actions of buyers and sellers in an open market. I got 60,000 transactions to choose from. Which ones have equal utility to my house? That will dictate the price of my house. And then interestingly enough, the part that people forget is the idea of vacant land. Anytime that you're pricing vacant land, all you do is go find other similar vacant land. Is it in the same area? Is it the same use? If it's sold for a certain price, yours probably will too, if it's in the same area and has the same use. Okay, so sales comparison approach there, single family residential and vacant land. Because of the way my page is clipped here, you may not realize that the ideal comp goes with the sales comparison approach. So let's talk about a couple of things real quickly on the sales comparison approach. In choosing the ideal comp, and this is a test question. I mean, this is the type of test question they would always ask. In choosing the ideal comp, what you want to do is pick the comps that are most similar to the subject property. So first of all, you need to remember what the words comp and subject mean. Comps are the comparable properties. Subject is the property I'm trying to evaluate, right? Okay, simple enough. So I pick comps that are like the subject property. What do I mean by that? Same or similar neighborhood, as close by in proximity as possible, preferably within a mile, preferably within the same neighborhood, but preferably within 1 mile. Similar size. Now, when I say similar size, keep in mind there can be some fluctuation here. If I'm looking at a 2,000 square foot home, I will often look up to maybe 2,400 square feet and down to 1,600. I'll bracket it within that. So they don't have to be exact, but they need to be similar. Similar amenities. They should have, the normal heating and cooling and stuff like that. They would be comparable. That's what I mean. Similar amenities. That's what I mean by the ideal comp. Now, how would we ask this to you on a test question? Well, what we might do on a test question is something on this lines. We'll give you a list of properties and we'll say which one is most comparable, or conversely, we may say which one is the least favorable comp. So I may give you a house that's a little bit larger. Well, yeah, I gotta be honest with you. A house that's a little bit larger, I can adjust it for square footage. I got no problem with that. I might give you a house that's a 1-car garage and the subject property is a 2-car garage. That's fine. I'll just adjust for half a garage. Maybe one of them has 4 bedrooms, the other one has 5. Maybe one of them has 3 baths, the other one has. I can adjust for all of that. Here's where the question 9 times out of 10 goes. Do not use foreclosed properties as comps because they do not show typically motivated buyers and sellers. So they're just horrible comps. The other one that historically has been an issue is if I give you a comp that sold 2 years ago. Well, something that sold 2 years ago does not show today's values. So, really old comps or foreclosed comps. And matter of fact, when it comes to the foreclosed comps, it doesn't even have to be foreclosed. It could just be someone that's under distress. So in the 4 comps that they list, they may say something like this. A seller had to sell the property quickly because they were in jeopardy of losing a job or they had a health issue or something like that. Foreclosure or distress sales just do not make good comps. 9 times out of 10, there's your test question, okay? Sales comparison, try to know that one really well. Clearly, that's the math question you're going to get as well, okay? The next approach to value is the cost approach, next by virtue of the fact that it came up next. Nothing more important than that. Actually, it's probably the least important in the field of all the approaches because agents will never do a cost approach scenario. The reason for that is, notice my first bullet point. When would a cost approach be used by an appraiser? Unique properties. Unique properties are exactly opposite of those properties in the sales comparison approach. Remember in the sales comparison approach, I told you we had 60,000 to choose from? Well, remember in the cost approach, I may not have any. I mean, how many movie theaters do you sell in a given year? How many historic churches or schools or something do you sell in a year? We just don't have comps. So we have to figure out a way to calculate it. Well, the way you calculate using the cost approach is you figure out the value of the land. And the way you figure out the value of the land that it's sitting on is you'd use the sales comparison approach because that's the way we value land. Then you would figure out the depreciated value of the building that's on the property. And what I mean by the depreciated value is we talk about what would it cost to build that building today? Well, it would cost us $5 million to build that building today using today's standards, today's comps, today's prices. Well, that building wasn't built today, so we're going to depreciate that building based on its effective age. and that will tell us what the depreciated value of that building is. And then we'll add the land to the depreciated value, and that's the cost approach. You know, you're not doing this in the field, so keep all of this very, very topical on here. Appraisers over in the Oakwood area, they might do this on a regular basis, because what they have is a really expensive lot because it's inside the belt line, and then they have this house that's probably old but has been improved multiple times. So they just figure out the value of that building based on its improvements. That's how they calculate it inside the belt line. Now, having said that, I don't want to diminish the fact you could have test questions on these vocabulary words. Replacement cost is just simply what it costs to build it today using today's standards. You would want to compare that to the reproduction cost. Reproduction cost is how much it is to make an exact replica, okay? So reproduction cost is very, very rare unless you're talking about old historic properties. Effective age, that's the age that a building appears to be, given its upkeep. And what I mean by that, its effective age may only be 8 years. It looks like it's 8 years old. It's actually 20 years old, but somebody has done a great job keeping up with it. So 20 is its chronological age, but 8 is its effective age. And then economic life is the period of time that you would use this property as opposed to tear it down. When you hear someone talk about a tear down, that means it has just gone past its economic life. These are just vocabulary words to you. Please associate with the fact that they go with the cost approach. The cost approach, as I've just described it to you, is clearly subjective. Okay, somebody had to come up with an effective age. Somebody had to come up with an economic life. There's no doubt that it is to some extent subjective. And then also dealing with vocabulary words, not beyond, methods of depreciation. Since I told you that's the depreciated value of the building, then I also have to tell you how we depreciate the building. But it's just vocabulary to you. What I described to you up here was what's known as the age life method. How old is the building? What is its life? Compare a ratio to it and depreciate the building that way. Market abstraction method, don't try to learn this. It just simply applies market metrics. All buildings in this area depreciate 2% per year. Therefore, your building must depreciate 2% per year. That's it, okay? It tends to be more objective than the age life method. Now, the breakdown method historically is where we've asked test questions. And the reason for it is because it's so easy to write a test question on the breakdown method. Because in the breakdown method, not that you need to know it any better than any of the others, but the vocabulary that goes with it. So in the breakdown method, the appraiser takes into consideration the following things. When they're figuring out depreciation, how does physical deterioration affect this building? Well, if you're looking at a building that's maybe 5 years old, it probably needs, it's a commercial building that gets a lot of traffic, it probably needs its carpet replaced. So the appraiser would deduct it by the value of the replacement of the carpet. It probably needs, if it's 20 years old, it probably needs a new HVAC system. They would deduct for that. Physical deterioration, that's one of the things that he would consider in the breakdown method. Functional obsolescence, this has always been a great question for the test as well. Functional obsolescence, I use it in class. I typically just simply say a building is past its prime. It's outdated. Okay, and what do I mean by outdated? Well, I've seen some questions that based on the idea of the floor plan was outdated. In other words, they would apply this to a house. Think about a house built in 1973. You know, the kitchen is small, the closets are small. That's completely opposite of the way you build a house today. We build huge kitchens, huge closets, etc. It's not a bad house. It's just functionally obsolescence. Have you ever seen a house where you had to walk through one room to get to another, walk through one bedroom to get to another bedroom? Nothing wrong with that house. I mean, it's completely livable, but it's functionally obsolete. It's not the way we build houses today. If you want to apply that to commercial, notice that I've put outdated wiring or plumbing. Buildings that were built back in the 70s and 80s, commercial buildings, they had no idea that we would need as much electrical grid for our, and certainly they had no infrastructure for Wi-Fi and stuff like that at the time. That's what we mean by outdated. And then finally, economic obsolescence. The appraiser will take this into consideration as well. And economic obsolescence, something has changed outside of the building owner's ability to control it. And notice my examples down here. That's probably the best way to study economic obsolescence. We have flights from certain areas of the city. People have moved from the cities to the suburbs. Well, if that's the case, the downtown areas are going to lose their value. In Detroit, the automotive industry shuts down. Well, obviously that affects property values, and there's not a thing in the world that owners can do about it. It is what it is. Okay. Economic obsolescence, examples of that. And then also focus on this concept as well. If as the property owner, I can't do anything about it, economic obsolescence is always incurable. You know, it's not like this old carpet up here. If carpet's old, I could just replace the carpet. I can't replace the fact that the automotive industry shut down. Okay, always incurable. It's weird that the cost approach, you don't have to know how to do it, but it's so prime for questions. I would at least study the vocabulary. Good news is only level 1 on vocabulary. Income approach is actually very important. Some good vocabulary here too, and you're clearly going to get a math question on this that we'll go over next week as well. But the simple part of it is income approach is used for income producing properties. Now, think about it. When I say an income producing property, the property itself produces the income. In other words, an apartment complex makes money by virtue of being an apartment complex. A mini storage facility makes money by virtue of the fact that people pay money to be able to use the space. McDonald's, on the other hand, makes money by selling hamburgers, not because of its building. Okay, so when I say an income producing property, the building itself is actually producing the income. So we evaluate those properties based on its net income. And remember, and I will beat this back into you next week. So go back and study your notes on this, but be prepared that you're probably going to have to learn this from scratch. On the income approach, there is a cash flow formula that we're going to follow. And once we get to that, to the logical conclusion of that, we will have derived the net operating income. Notice it's net operating income. How much did you have left over after you paid all the expenses of the building? Divided by the capitalization rate. The capitalization rate speaks to the return that an investor would like to get, equals the value. And the reason that value is important is this is the valuation chapter. So we have to have a way of determining the value of those properties. So sales comparison approach, single family homes, vacant land. Cost approach, unique vocabulary, and have some examples of that. Income approach, income producing properties, and there's a formula associated with it. Okay, now that I have done all three, technically speaking, now that the appraiser has done all three, he is going to reconcile these. Well, the first thing he's going to do is take the sales comparison approach and look at the three properties that he uses comps and says, which one is the most similar to the subject property? When he does that, now this is actually important. If this question comes up, it's a slam dunk if you know what to look for. When you do a reconciliation on the three comparable properties in the sales comparison approach, the appraiser never just averages the properties. In other words, he doesn't just take all three of them and add them together and divide by 3. That's averaging. What he does is a weighted averaging. There's one comp that's more similar. I'm going to give it 50% credit. The other two less similar, I'll give one 30%, one 20%. So that's what I mean by a weighted averaging of the properties. Don't fall for any question that leads you to believe that the appraiser just adds them together and divides by 3. That's not the way they do it. Then the other definition of reconciliation is now what the appraiser looks at is he looks at all three methods. He did the sales comparison approach, he did the cost approach, and he did the income approach. And if you ever look at an inspection report, you'll see where the appraiser does this on the back page, and he'll say something to the effect of, after looking at all three approaches, I believe the one that's the most applicable will be the sales comparison approach. Why? Because this is a single family home in a single family neighborhood. Okay, so that's kind of the way that process works. It's not perfect, but it's close enough for our purposes. Okay, that actually is the end of the valuation chapter. And then as I was thinking through this, I just made a couple of other notes to myself that of some things that pop up on the exam that I didn't have anywhere else in this course. That's all these things down here at the bottom mean. As you go back and study, remember the advantages and disadvantages of being an independent contractor versus an employee. We actually went over that in class, so you'll have a few notes on that, but just to remind you what they are. Independent contractors, hey man, you got all kinds of flexibility being an independent contractor. Technically, you have unlimited income potential. Now remember, unlimited income potential is as much as you want to make or zero, depending on how hard you work. But I mean, independent contractors, you're not paid $11 an hour, you're paid whatever you produce, okay? So those, you look at it as advantage or disadvantage. Disadvantage of being an independent contractor, you're not getting any benefits. So when you're calculating how much money you have to realize you're paying for your own benefits, okay? Why do we even go over this in this class? Most real estate agents are independent contractors. So we just want everybody to understand what they're getting into on that. Hey, look, there's some tax advantages for being an independent contractor. There's also some tax disadvantages for being an independent contractor. When I worked for somebody else, they took the taxes out of my paycheck, so I didn't even have to worry about it. Independent contractor, I have to be disciplined enough. Every month I set 30% aside to make sure I can pay taxes when they come due. Stuff like that, okay? And then the advantages of being an employee are the exact opposite of the disadvantages of being an independent contractor. So for example, as an employee, hey, I can get benefits. I know every 2 weeks I'm getting a check in my mailbox. These are advantages. Disadvantages of being an employee, I know exactly how much money I'm going to make, no matter how good a job I do. I know how much I'm going to make, and I have to be there 9 to 5 or whatever it is. Those are fairly straightforward. And then also advantages and disadvantages of being a sole proprietorship. Again, just real briefly on these. These are in chapter 19, so you can go do a short list of these, but keep it a short list, 2 or 3 bullet points, move on. Advantage to me of being a sole proprietorship is I don't have to split my money with anybody. I own it all. Okay, that's fantastic. I get to make all the decisions. What's the disadvantage of being a sole proprietorship? I don't have anybody to help me when it comes to investment purposes because it's just me. There's no one to share the debt with. And also, I have to make all my own decisions, which if they're crappy decisions, I end up, I'm responsible for that. Partnership has its advantages. Partnership, now I can make it's easier to raise capital because there's more of us. It's not just me, that's 2 or 3 or 5 people that are raising capital. The downside of it is I have to split it now with those 5 people. Now we're going to have some way of making decisions because it's not just me, it's other people I have to deal with. And then once you get into LLCs and corporations, they have the same advantages and disadvantages of a partnership, with the difference being that they offer some level of protection against liability. LLC stands for a limited liability corporation. So obviously part of the reason for an LLC is to isolate you from liability. But again, you don't go deep on this, but also don't ignore it because it could be a cheap test question that may slide in. Okay, so here we are, close to 8 hours later, and now you have seen this review. I do have it all recorded. I'm actually going to stop recording it right now so we can just chat.